So, Conall, the NDRC are running their accelerator program where they're offering €100,000 investment into early stage tech companies. They're doing this via SAFE. So there's lots of media coverage that SAFEs are founder friendly, but you're going to take us through some of the considerations and caveats for tech companies considering this type of investment. So first things first, what is a SAFE?
Well, for startups looking to raise money, a SAFE is potentially a way of doing this in a faster and more efficient way than a traditional loan note. So SAFE itself is an acronym for Simple Agreement for Future Equity. And kind of as the name implies, really, it's an arrangement where an investor can give money to a company now in exchange for an unspecified number of shares in the future.
Okay, so if the investor is giving money to the company now, why isn't the company issuing shares now?
That's a great question. So valuation is a big issue for most early stage companies. It can be hard to agree an objective valuation for a company that that doesn't have significant revenue, or maybe the founders just don't want to give away too much equity at an early stage. So what the SAFE does is it solves this valuation issue in an elegant way by effectively just deferring the question. So what the investor and the company agree is, we'll give you the money now, and the number of shares you get will define it by a benchmark on a future investment round. So it's somewhat like a convertible loan note or EI HPSU shares in that respect.
Okay, so you're mentioning it's similar to convertible loan notes. Which would you say is more preferable for an early stage tech company?
Certainly a SAFE can be more founder friendly than a traditional loan note, but obviously depends on the exact terms that they do. So I mean, for a convertible loan note, I mean, ultimately it's a loan, and there are a number of things that a company and an investor would need to agree about a loan. For example, what's the loan interest rate? What's the maturity date of the loan? Like, is there a gun being held to the company's head? Is there events of default? So like, what if you miss your sales milestones or your KPIs? Do you have to repay the convertible loan? I mean, a SAFE in comparison is not designed to be repaid. Once the investor gives the money to the company, it is the company's money. I mean, on the flip side, that means that a SAFE perhaps offers fewer protections than for an investor than a traditional loan note would.
Okay, it sounds like there's a lot more negotiation points on a convertible loan note too. What would be the key negotiation points then if you're investing via SAFE?
So a SAFE certainly can have, again, much fewer negotiation points than a loan note. So SAFEs were invented by a famous American startup called Y Combinator. And I think it's probably fair to say that their versions of SAFE documents are like the definitive versions. And if you look at their documents, there's really only 2 points that you negotiate. Is there a discount and is there a valuation cap? And that's it.
Okay, and how do each of those mechanisms work?
So the discount is effectively the investor agrees, when I get shares in the future, I get them at the next investment round price at some particular discount. And you might see anywhere up to 20% just by way of example. And interestingly, that this is the approach that the NGRC have said that they will take for their SAFE, but certainly it's probably the slightly less common approach. The other approach that you could take is a valuation cap, where the investor simply says, the maximum price that I will pay for my shares is X euro. And there's really 2 ways I would mention, actually, Sarah, just in terms of how the valuation cap works. And I think it's important that people are aware of these differences because it can have a material impact on the equity you get. And in simple terms, you can either have a pre-money valuation cap or a post-money valuation cap. And again, depending on the mechanics of your share cap table, the pre-money cap is arguably the more founder-friendly mechanism, and the post-money valuation cap is maybe the more investor-friendly mechanism. And the reason that you need to know this, again, is Y Combinator originally drafted their documents on the pre-money founder-friendly version, but they've recently flipped to being a post-money, potentially more investor-friendly version. So ultimately, if you're working with documents from the internet or documents that someone has given you, and you're going this valuation cap mechanism, just be sure to know whether it's pre-money or post-money. And if you're a founder or an investor, know which one might be better or might be worse for you.
Okay, so be careful downloading documents from the internet, Conall. Great, there's loads of really good points there. Is there anything else that tech companies that are considering SAFE investments should take into account when going down this route?
Yes, actually, I would just say that I'd probably pick up on your last point there. Please be careful about downloading documents from the internet. I've mentioned the Y Combinator safe documents, but they are written for US corporations issuing US stock, not Irish companies issuing Irish shares. That being said, though, I realize, companies have to be pragmatic to work towards solutions for fundraising. So, if you do want to use those documents, or if you're using documents provided by someone else that maybe has been tweaked for Irish law, I would just simply say do your due diligence on what you're signing or what you're being asked to sign. So one, ask and check if the safe documents you're signing are the vanilla Y Combinator standards, or has the company or the founder put in some additional terms? And secondly, if you are going with this more common valuation cap mechanism, do check the document and see, is it pre-money valuation or is it post-money valuation? Because this could have a material economic impact on your equity percentage, whether you're the founder or the investor. So it's just important to get that right.
Okay, great. Thanks, Conall. I think you've raised some really good points for tech companies that are considering safe investments.
Okay. Thanks, Sarah. Thank you for watching our vlog. For more information and videos on issues relevant to Irish business, hit the like button and subscribe to our channel. Thanks.